The New York Association of Business Economics meeting with the Vice Chair Clarida from the Federal Reserve Board. We have our season of regular speakers has been a bit derailed by COVID-19, and so we're very honored and grateful to have the Vice Chair reinitiate our season and help end it with an update on the economy and on monetary policy. So we thank him very much for doing this virtually. I hope that the technology works smoothly and well. Prepared remarks from the Vice Chair, and then we're going to do some Q&A afterwards. So without further ado, we'll turn it over to Vice Chair Clarida.
Well, thank you, Julia, and I will begin with some prepared remarks, and I look forward to our conversation after that. So it's my pleasure to meet virtually with you today at the New York Association for Business Economics. I've been looking forward to this session, and I'm sorry I cannot join you in person, as I always do value opportunities for dialogue with business and market economists, as Julia will attest. Since mid-March, along with my FOMC colleagues, I have been working from home. And while I certainly miss the opportunities for interactions along the corridors of the Eccles building, I am grateful to be able to work from home. And right now, I do want to convey my deep gratitude to all those on the front lines of the crisis who are working outside the comfort of their homes in hospitals, emergency services, and other essential activities. Now, while the coronavirus pandemic has taken a tragic human toll, measured in terms of lives lost and suffering inflicted, as a direct result of the necessary public health policies put in place to mitigate the virus, the pandemic has also inflicted a heavy toll on the levels of activity and employment in the U.S. economy. Real GDP declined at a 4.8% annual rate in the first quarter of this year and will almost surely continue to contract at an unprecedented pace in the second quarter. The unemployment rate, which was at a 50-year low of 3.5% as recently as February, surged in April by more than 10 percentage points to 14.7%, an 80-year high, and it is likely to rise further in May. Now, to put these numbers in some context, more jobs were lost in March and April of this year than had been created in the previous 9 years. So while the economic news has been unremittingly awful in recent weeks, financial conditions since the middle of March have eased, and considerably so in many markets. I believe, and most outside observers agree, that this easing of financial conditions is at least in part a direct consequence of the actions the Fed took at the meeting, the subsequent announcement over following days of the creation of 9 new credit facilities to support the flow of lending in the economy, the robust expansion of our existing FX swap arrangements with major foreign central banks, and the establishment of a new FEMA repo facility with eligibility for a broad range of countries. Now, while this easing of financial conditions is, of course, welcome, whether it proves to be durable will depend importantly on the course that the virus takes and the duration of the downturn that it causes. At a minimum, the easing of financial conditions is buying some time until the economy can begin to recover, until growth resumes and unemployment begins to fall. As I speak to you today, there is an extraordinary amount of uncertainty about both the depth and the duration of the economic downturn, because the course of the economy will depend on the course of the virus and the public health policies put in place to contain it. There is an unusually wide range of scenarios for the evolution of the economy that could plausibly play out over the next several years. In my baseline view, while I do believe it will take some time for economic activity and the labor market to fully recover from the pandemic shock, I do project that the economy will begin to grow and that unemployment will begin to decline starting in the second half of this year. In terms of inflation, my projection is for the COVID shock to be disinflationary, not inflationary, and the data we are seeing so far are consistent with this projection. For example, core CPI inflation fell nearly 0.5% in April, the largest monthly decline since at least 1957. While the COVID shock is disrupting both aggregate demand and supply, the net effect, I believe, will be for aggregate demand to decline relative to aggregate supply, both in the near term and over the medium term. If so, this decrease will put downward pressure on core inflation, which was already running somewhat below our 2% objective when the downturn began in March. Moreover, as I have indicated previously, I do judge that measures of longer-term inflation expectations when the downturn began were at the low end of a range that I consider consistent with our 2% inflation objective. At the Federal Reserve, we take our dual mandate obligations of maximum employment and price stability very seriously. And since March 3rd, we have deployed our entire toolkit to provide critical support to the economy during this challenging time. In 2 unscheduled meetings, we voted on March 3rd and 15th to cut the target range for the federal funds rate by a total of 150 basis points to the current range of 0 to 25 basis points. In our FOMC statements, we've indicated that we expect to maintain the target range at this level until we are confident that the economy has weathered recent events and is on track to achieve our dual mandate and price stability goals. On March 16th, we launched a program to purchase Treasury and agency MBS securities in whatever amounts are needed to support the smooth functioning of financial markets and thereby foster effective transmission of monetary policy to the economy through financial conditions. To date, these purchases have totaled more than $2 trillion, and as we indicated following our April meeting, they are continuing, but at a reduced pace, reflecting the substantial improvement in market functioning that has occurred since the program was launched 2 months ago. Since March 17th, the Federal Reserve Board has voted and announced the establishment of no fewer than 9 new facilities to support the flow of credit to households and businesses. These programs are authorized under emergency lending powers granted to the Fed under Section 13(3) of the Federal Reserve Act and are available only in unusual and exigent circumstances, and importantly also with the express consent of the Secretary of the Treasury. I think you will agree that today we face circumstances that are both exigent and unusual. These facilities are supported with money invested by the Treasury, drawing on appropriations of more than $400 billion authorized by the Congress in the CARES Act for the specific purpose of investing in Fed programs to sustain the flow of credit to households, firms, and communities during the coronavirus pandemic. With these facilities, we are providing a bridge by stepping in and supporting lending throughout the economy until the recovery takes hold. These programs are designed to offer backstop sources of funding to the private sector. And just the announcement that these facilities would soon be launched appears to have bolstered confidence in financial markets and has allowed many companies to borrow privately even before the facilities are up and running. But importantly, these are, after all, emergency facilities. And someday, hopefully soon, the emergency will pass. When that day comes and we are confident the economy is solidly on the road to recovery, we will wind down these lending facilities at such time as we determine circumstances are no longer unusual nor exigent. Not only is the Federal Reserve using its full range of tools to support the economy through this challenging time, but our policies will also help ensure that the rebound in activity when it commences will be as robust as possible. And there can be a good rebound on the other side of this downturn. That said, it's important to note that the Fed's statutory authority grants us lending powers, but not spending powers. The Fed is not authorized to grant money to particular beneficiaries, to meet the payroll expenses of small business, or to underwrite the unemployment benefits of displaced workers. Programs to support such worthy goals reside squarely in the domain of fiscal policy. The Fed can only make loans to solvent entities with the expectation the loans will be repaid. Direct fiscal support for the economy is thus also essential to sustain economic activity and complement what monetary policy cannot accomplish on its own. Direct fiscal support can make a critical difference not just in helping families and companies stay afloat in time of need, but also in sustaining the productive capacity of the economy after we emerge from this downturn. Now, fortunately, the fiscal policy response in the U.S. to the coronavirus shock has been both robust and timely. In 4 pieces of legislation passed in just over 2 months, the Congress has voted $2.9 trillion in coronavirus relief, about 14% of GDP. This total includes nearly $700 billion for paycheck protection and more than $450 billion for the U.S. Treasury to provide first loss equity funding for Fed credit facilities that I discussed earlier. Now, while the scale, scope, and timing of the monetary and fiscal policy response to the pandemic are unprecedented and will certainly cushion the blow the shock inflicts on the economy, the shock is severe. And depending on the course the virus takes and the depth and duration of the downturn that it causes, additional support from both monetary and fiscal policies may be called for. In conclusion, the coronavirus pandemic poses the most serious threat to maximum employment and potentially also to price stability that the United States has faced in our lifetime. There is much that policymakers and epidemiologists simply do not know right now about the potential course that the virus and thus the economy will take. But there is one thing I am certain about. The Federal Reserve will continue to act forcefully, proactively, and aggressively as we deploy our toolkit, including our balance sheet, forward guidance, and lending facilities, to provide critical support to the economy during this challenging time, and to do all we can to make sure that the economic recovery, when it commences, is as robust as possible. Thank you very much, and I look forward to my chat with Julia.
All right. Thank you so much, Vice Chair Clarida. I have collected a number of questions from our membership, so I'll start posing those to you now. You highlighted a very sobering outlook, but also one that is fraught with uncertainty. So a number of different scenarios are quite possible, and that was something that was also highlighted in the minutes to the April meeting. So just a logistical question to kick it off with. Against this backdrop, is it useful to present a baseline outlook in the summary of economic projections, or would you anticipate that that continues to be suspended at the June FOMC meeting?
Julia, as Chair Powell indicated at his press conference, we would expect to return to the SEP process at the June meeting, and that is what we will do.
Okay.
The SEP will be back.
It'll be back, and you will present that baseline, although there is a number of other alternative scenarios, mostly with respect to the downside.
Yeah.
So do you also indicated that, the current stance of monetary policy is appropriate. And what are you looking to clarify? The minutes discussed a number of options for providing clarity on monetary policy, both in terms of your intentions with interest rates, your intentions for balance sheet policy, and the evolution of balance sheet policy. And there was sort of a menu of options that was discussed and outlined in the minutes. what are you looking to provide that clarity? Is it mostly clarity about the outlook, or is it a process of discussion and weighing the costs and the benefits of these different options?
So a couple of points on that, Julia. First and foremost, just to review what we said in April, is that rates are on hold until the economy has weathered the coronavirus shock, and we're confident that we're on track to achieve our dual mandate objectives. We also indicated, I think appropriately, that there is heightened considerable risk even over the medium term. So I think risk management is also relevant. And with regards to balance sheet, what we've said is that we're going to continue to purchase treasuries and mortgage-backed securities in the amounts needed to sustain market functioning and the transmission of our monetary policy. As you point out, the minutes did indicate that in coming meetings, we may well choose to return to our communication and thinking about our balance sheet to discuss ways in which we might refine communication or communicate and think about options for our balance sheet. But that's down the road. In terms of the way I think about it personally, and again, you and I have both been forecasters and for a long time, we are just really in an uncharted situation right now. And I think that my own sense is that we'll begin to get a better sense of the scenario and the trajectory that the economy is on in the early fall. The numbers we're going to have a precipitous decline in GDP in the second quarter. We're going to see unemployment rates we've not seen in 80 years. And unfortunately, because of the appropriate efforts put in place to mitigate and contain the virus, we've shut down big chunks of the economy. So this is a very unusual shock. The economy was in great shape as recently as February, the last time you and I were together face to face. And so it's going to take some time for us at the Fed to get a sense of what this economy, what the rebound potentially can look like. And so I think it's natural for us to gather more data and insight on the situation as we think about potential refinements to our guidance and our balance sheet communication.
Okay, that's excellent clarification. Thank you for that. So when you're thinking about the evolution of that outlook, we know there's a lot of problems in gathering and assessing the economy. What are your preferred gauges, or how are you evaluating the state of the economy and the likely trajectory as we move through the summer and into the early fall?
Yeah, well, I'm a data wonk at heart, so I'll look at high frequency data, and luckily a lot more of that is available. And I look at everything. The Fed staff has just done a fabulous job throughout this under the able leadership of Stacy Tevlin and RNS. And so I think we've been very well briefed and equipped with the high frequency data. So I wouldn't pick out any one individual indicator. I will say, and I want to restate something that Chair Powell has emphasized as well, is I think one thing, Julie, we're all going to be looking for is indications that once the economy starts to recover, the underlying capacity of the economy is in place. The longer this goes on, and hopefully the duration of the downturn will be brief, but the longer the downturn goes on, the more we would have to look for evidence that the productive capacity of the economy has been impacted, important connectivity between workers and firms. And so we're looking at that quite closely. It's an active area of interest as well. And I think the honest answer is right now it's just too soon to tell. The recession began probably March 1st. So we're really only into, the second or third month, and hopefully it will be a brief downturn, but it's just too soon to tell right.
Yeah, so some of the things that would tell you about that deeper damage, I assume, would be one, like labor market indicators of more extended spells of unemployment, maybe also delinquencies as well, because I know there was concern highlighted about possible rising delinquencies and the stability of the banks. Is that also a concern? Is the credit risk in the economy?
It's not a concern right now. What I would say is through efforts both in legislation and in supervision and regulation at the Fed and other agencies, the banking system in the U.S. entered this crisis in very good shape. The banking system has been a source of stability and lending into the economy, in contrast to 2008. High levels of capital, liquidity, very sound balance sheets. Obviously, forbearance is an important element right now in the mortgage market and some other markets. And again, we just published a financial stability report on Friday that went into some of the risks and potential risks down the road. But I think as I sit here right today in the middle of May, the banking system is really a source of strength and a source of credit in the economy, and that's important.
So another issue that came up in the minutes was that it sounds like the policy review that you were actively engaged in and in fact managing was before the crisis hit, that the results of that, which had been sort of slated for mid-year or around mid-year, have been potentially pushed back to later in the year. So do you expect that to the results of that to coincide with the time period around which you can provide further clarification of monetary policy, or are those two separate issues? And what elements of that review that had already been sort of well underway have been the most helpful to you in this current crisis?
Yeah, so a couple of points. First and foremost, as you and many of your viewers may know, we devoted the entire year of 2019 to a very extensive review of our monetary policy framework, which included a number of public events, Fed Listens events. In fact, we're doing another Fed Listens event this afternoon. We did a conference in Chicago. The Fed staff, over 6 or 7 consecutive FOMC meetings, gave us extensive briefings. And in February, we were very close to converging to agreement and a set of conclusions. Since March 1st, our entire focus and priority in the system has been doing what we can in terms of monetary policy and setting up these facilities. And so it was entirely appropriate to put the review on the back burner. But it is my expectation now that we will return to the review later this year. Although, again, our priority now is going to be the monetary policy that we need to have in place in the facilities to provide support to the economy. But I do expect we will have an opportunity to get back to the review. As I've said, we were quite close in February, and so I believe we'll be able to accomplish that. In terms of what I took away from it, we have 17 folks around the table, so I'm sure you'll get at least 17 opinions. What I took away from it is a couple of things. First and foremost, in a world where equilibrium policy rates are low globally, the low R-star issue, and in a world where we really had secular disinflationary forces through the channels that we know, it's crucially important that central banks not only communicate but conduct policy that can anchor inflation expectations solidly at the target. In our case, that would be 2% on PCE inflation. And nothing that's happened in the last 2 months has diminished the importance of making sure that policy does everything it can to anchor inflation expectations. The other thing I think we've learned from the review, or at least highlighted something that we probably already knew, are the incredible benefits in the economy of fully achieving and sustaining maximum employment. In February, the unemployment rate was low. One of the things that's pointed out was the incredible benefit, especially the groups in minority groups and groups with lower education and opportunity. This is really the first glimmer of opportunity they saw was in this hot labor market. And certainly, I think I do speak for all 16 of my colleagues that that message was received, and we are going to redouble our efforts to do everything that we can to restore maximum employment, notwithstanding the shock the economy is taking right now.
Yeah, thank you. That actually is a nice segue into a group of questions on the inflation outlook. I guess first, what is your assessment of the state of inflation expectations? You highlighted that we've seen some of the greatest disinflation and outright deflation that we've seen since the Great Depression. That's not shocking, but it's near term. What is your assessment of inflation expectations right now? what is your sort of near-term outlook for core inflation over this year?
Yeah.
And one of the, we've sort of concluded that the Phillips curve is flatter than we previously thought. Does that still hold, or are you seeing greater flexibility in wages that might bring greater downward pressure on inflation?
Okay, there are several parts to that, so I'll take them in turn. So as I said in my prepared remarks, on balance, I think the COVID-19 shock is going to be disinflationary, not inflationary, both in the near term and the medium term. We only have one data point, which is that CPI release, but that certainly showed that in cyclically sensitive sectors, you've had a big decline in prices. So my view coming into the year, January would have been that core inflation this year would have been somewhere in the range of 1.8, potentially 1.9, depending upon the year. And I've marked that down, probably in line with most private forecasters, maybe the 1.4, 1.5, at perhaps downside risk to that. In terms of the state of inflation expectations, as I mentioned in my prepared remarks, and I think in virtually every speech I've given as a Fed Vice Chair, I do think inflation expectations are important, and I do believe that although we don't observe them, if I look at a variety of measures, going into this crisis, they were at the low end of a range that I considered consistent with our 2% objective. And so I don't think we have a lot of data since then, but it's certainly something I'll be looking at closely. As you know, Julia, I look not only at the market data, break-evens, but also Michigan and other surveys and models. And I think it's important to look at a wide range of measures. In terms, what was the third part of your question? I'm drawing a blank. I think you asked.
The flatness of the Phillips curve.
The flatness of the Phillips curve.
Still flat.
Okay. Well, when I look at the Phillips curve, I always distinguish between the wage and the price Phillips curve. The price Phillips curve relationship between price inflation and slack really flattened out across the world substantially in the last 25 years. There has been less flattening in the wage Phillips curve, and so I think that's an important distinction. As you well know, that one of the things that was useful in the last downturn in 08 and 09 is that the price Phillips curve was pretty flat, and so there was a pretty modest decline in core inflation, given what at the time was a very high unemployment rate. I think it's too soon to tell right now if there's been a shift in the price or the wage Phillips curve, but it's obviously something that we're actively studying and modeling at the board with staff.
Okay, thank you. The next set of questions is around the balance sheet of your policy. So a couple of quick questions. One, when you're moving into that early fall period, maybe thinking about providing greater clarity around monetary policy, do interest rate and balance sheet policy go together as a package, or do you sort of take them separately and maybe provide clarity sequentially as you make decisions? That's question number one. Another question is, the bond purchases to date have been motivated, as you mentioned, out of a desire to secure market stability and the flow of credit to the real economy. As you're thinking about monetary policy, how do you cast bond purchases once we have that financial stability and flow of credit? Do they still play a role? It seems like in a world of low interest rates, the prior QE motivation of putting downward pressure on term premium may not be the same motivation. So if you could shed some light as to how you're thinking about the bond purchases.
Sure. So a couple of points, just to quickly review our current policy, as we stated in our April meeting, is that we are going to direct our colleagues at the New York Fed to purchase treasuries and mortgage-backed securities in amounts needed to sustain good market functioning and support the transmission of policy of the real economy. And those purchases continue. They commenced in a very large size in March, and we've scaled them back as market functioning has improved, and those purchases are continuing. As the minutes indicated, at some point, the committee may return to discussions about the balance sheet and about the pace and composition of purchases, but right now the New York Fed is purchasing in the amounts needed for those purposes. In terms of the way that I think about the balance sheet and rates and guidance, I think at some level they all have to complement each other. It's all one. We have one goal, which is to achieve our objectives, and so I do think you need to understand the tools in together and not individually. That being said, depending on circumstances and depending upon a variety of factors, it can make sense to sequence decisions as well. So I don't think there's a one-size-fits-all answer to this. I think it's going to depend on circumstances, but I think it is important. I think sometimes folks, and I did it for almost 14 years, sometimes folks, I think in markets, lose sight of the big picture. And the big picture is that our whole policy package and our whole set of communications and guidance is very easy to understand at the 30,000-foot level. We're going to do everything we can to provide the support the Fed can to achieve our dual mandate objectives. And as circumstances and data flow change, that may require different calibration. But the agenda is the same. Use the toolkit as effectively as we can to achieve our objectives.
That's very useful clarification. And one of the things one of the policies that was mentioned in the minutes, and I know was sort of coming to the forefront in the policy review, was the possibility of capping yields, and that would be one policy. Could you talk about your thoughts on that?
Sure. Yeah. So one of the things that we said, indeed, in the first public comments I gave on the review in New York in February of 2019, I alluded to the fact that an important element of the review would be for our staff to canvass and summarize for us the policy practice that other central banks around the world have deployed that we have not chosen to deploy. And one of those is yield curve control. At the time, there was one prominent central bank that was deploying yield curve control. That's Bank of Japan. Since March of this year, there's a second. The RBA is doing yield curve control. And so certainly it would make sense for us at some point to get a briefing from staff on the experiences in those countries, what has worked, what has not worked, could it be applicable to the U.S. And so, any such briefing would be down the road, but I think just good governance and to be responsible, the review should look at what other central banks are doing that we could consider. What I would say on yield curve control from my own perspective is that at one level, it's a natural complement to calendar-based guidance. Indeed, the RBA is doing that very, very specifically. So in the RBA, briefly what they're saying is that they anticipate rates are on hold for at least 3 years. They're providing 3 years of term funding to commercial banks, and they are endeavoring to keep the yield on 3-year sovereign bonds in a pretty tight range. And so there you really have a very tight connectivity between the forward guidance, the bank liquidity facility, and yield curve control. So that's one natural way. That's not the only way. If you go back to the 1940s, well before we were all around, the Fed was a pioneer in yield curve control during World War II. And in those days, it was part of the war effort. And it was actually a pretty complex and system. If you look at this, we can't argue that the Fed's a big work on this. So in summary, other central banks are currently deploying this, and I think it will make sense for us at some point to be briefed on how well that's worked and whether or not it's applicable to the U.S., but that would be down the road, certainly.
Great, thank you. Well, I'm mindful that you have some time obligations, so I don't want to keep you much longer. I'm going to throw one last obligatory question on interest rates. You knew that was coming.
Okay. All right. Well, so what's the question?
What are your thoughts on negative interest rates as a policy tool? We've heard a lot about the pros and cons from a lot of Fed speakers, so you don't need to rehash all of that.
Yeah.
Maybe just answer, are there conditions under which you could envision revisiting negative rates as an active tool of policy, and what might those conditions look like?
Yeah, well, I think I will answer your question this way. So in October of 2019, the FLMC did receive a briefing from staff on negative rates and some of the international experience. And as the minutes to the October 2019 meeting will show, not one, not two, but all 17 participants around the table were in agreement that in the U.S. context, we did not feel at that time that negative rates would be a worthwhile approach for the Fed to take, and nothing that has happened since then has changed my mind about that. So I will just leave it at that.
All right. Well, thank you so much for giving us your time. We know you're busy. We appreciate all the hard work that you and your colleagues, both the staff and the other officials, are doing right now. And, you know, more power to you. Good luck. And we'll look forward to hearing from you down the road.
Thank you. Very good. Appreciate it.
Thank you, everybody, for joining us as well. Our next event will be with Constance Hunter, President of NAVE. She will